it. So good morning, everyone. I'm Mick O'Brien. I'm the Managing Director at Equity Trustees, and welcome to this presentation this morning. So it's a presentation what we've called What's Winning the 100, right? And why is it the 100? Well, because it's a presentation about our insights into trends in the funds management market based on the experience we've had in setting up managed investment schemes, our last 100 managed investment schemes that we've established. So hopefully there's some really useful insights you get from it as to the trends that are happening that are really current. In fact, because what you see here is schemes being set up to some extent before they're becoming public in the market and capturing funds flows. So welcome to the 100. Now, before we get started, Equity Trustees is a specialist trustee business. We've got trustee business across the spectrum. We certainly have a lot of First Nations communities as our clients. And I want to acknowledge First Nations people enduring connection to this land. I'm talking to you from Wurundjeri land, which is in Melbourne. So let's jump into it. Today you're going to hear, firstly, I'm just going to give an introduction before handing over to Alex Fiung. And Alex and Ben Ashton, both from our business development area in corporate superannuation and trustee services, and both been with us for a very extensive period of time in different parts of the business. You're also going to hear from Michael Trapia. Michael is new to Equity Trustees. He joined us just over 2 months ago, and he's in the role of General Manager, Governance, Risk, Compliance and Regulatory Affairs. Effectively, much of what we do in this part of the business is the governance of managed investment schemes. It's a really important part of our business, and increasingly so with the regulatory load coming on, and he's going to talk to you about some of the upcoming changes. Today's agenda, we're going to go through sort of a background as to how we have come across the data that we've got, the findings that we've got from that, a discussion at the end, and we'll have a question and answer session at the end of the session. So how we come across this data? Well, effectively, I mentioned before, Equity Trustees is a specialist trustee business. This is all we do. We're the leading provider of independent corporate trustee services for managed investment schemes. We have very significant scale in this area. We're trustee or responsible entity to about 500 investment schemes and funds for about 160 primarily funds managers, but also insurers, other sort of plan sponsors and promoters, and asset owners. We have capability across all of the asset classes that are available in the market, and of course across all types of investment structures that may be put into place. We're overseeing or governing about $110 billion of assets under management currently in this part of the business. The whole group oversees about $200 billion of assets when you look also at our superannuation and private client business. Through the course of the financial year FY24, we've established 66 new schemes. Now, that's the largest number of schemes we've ever established. So I sort of find that the funds management market through the course of the last 12 to 18 months has been more active and more dynamic than what we've seen in years. I think that's a reflection of, I guess we've seen very buoyant markets of late, but also a reflection of the trends that are happening in funds management in Australia, primarily driven by the scale of the superannuation, the largest superannuation funds. That is causing a more diversified sort of mix of managers and asset classes and structures coming to this market. Anyway, today what we're going to go through is the findings and the data from the last 100 schemes that we've established. So that basically takes us back about 18 months or so. So it's a very extensive data set. And I'm sure you're going to get some very valuable insights out of going through the information. So without further ado, I'll hand over to Alex, who will take you through the next part of the presentation. Thank you.
Thanks, Mick, and good morning, everyone. It's an absolute pleasure to be here on the panel today and to be able to share with you our next edition of the 100. So when we take a step back and look at the last 100 products which we've established, there's some pretty interesting themes and trends that emerged, in particular with fund types. Overall, FY24 has been a successful year, and we've seen increases across the board with various fund types. The biggest movers compared to prior years being the increase in unregistered wholesale products, along with a continuing steady rise in ETFs and quoted funds. The main contributors being overseas fund managers, again, seeing the opportunities in the Australian market and looking to plant their flag here to capitalize, as well as existing managers wanting to access the retail market with listed products. There are also other key reasons contributing to these increases, and we'll explore and break these down in a bit more detail in the next slides. With the rise of ETFs and quoted funds, it's impressive to see the growth trajectory and the future outlook from when we started this journey in 2021. When you look at the Australian market, superannuation assets stands at 3.9 trillion. Self-managed super funds represents a sizable portion of the market, with investors and advisors looking at easy entry points, with ETFs and quoted funds offering the desired transparency and liquidity. Because of this, we're seeing more and more self-managed super funds investing in ETFs and quoted funds. We're also seeing industry super funds putting ETFs on their platforms and super fund menus. And as such, fund managers are looking to build products and get on these platforms and menus. In May, we undertook a US trip visiting a number of US fund managers, existing clients and potential, including the Chicago Board of Exchange. And the feedback to us was clear. There is strong interest in ETF demand, and US fund managers are looking at Australia again as a place of opportunity. Product specification and design are also key reasons contributing to the rise in ETFs and quoted funds. With the structure of ETFs and quoted funds, we saw the emergence of conversions of existing unlisted products to dual access products. That has also evolved now to also include dual access of classes within a product, thereby providing managers the flexibility of structure and strategy. There is also increased understanding of market-making models and their evolution from the external market-making model for fully transparent ETFs to the internal market-making model, and now even a hybrid extension of the external market-making model with material portfolio information. Each offers managers differing options for control, risk mitigation, and protection of intellectual property. Concurrent with the rise of ETFs and quoted funds, we're seeing more counterparties increasing their capability to service market-making models and administrators building out their portfolio composition file solution. These offer managers the flexibility of counterparties and servicing at competitive rate cards. And finally, the accessibility of ETFs and quoted funds and the streamlined nature of the application process means that we're seeing more and more managers looking to incorporate this functionality within their products and offer this to their investor base. As I mentioned earlier, we started our ETF quoted funds journey in 2021 with the conversion of an unlisted product to a quoted fund, utilizing the internal market-making model and listing on the ASX. This has grown today to 15 products, and the pipeline of upcoming ETFs and quoted funds remains strong. The majority of our ETFs and quoted funds are listed on the ASX, and we're also seeing more interest from managers seeking to list their products on Cboe. Building on the evolution of market-making models that we mentioned earlier, we can see the increase in ETFs or quoted funds utilizing the external market-making model with material portfolio information, and we expect that this trend will continue given the increasing monitoring and oversight requirements on the internal model as required from ASIC and the relevant exchange. That being said, managers with an established internal market-making model and information barriers process can use this as an opportunity to build upon existing processes and frameworks, and also increase the robustness of their internal market-making model. In terms of main asset classes of our products, these are predominantly equities and fixed income, and we expect that to expand into other asset classes as we continue on the journey. There are asset classes that don't lend themselves to ETFs or quoted funds, in particular alternatives and real assets, due to the frequency of valuations and limitations with liquidity. However, we're seeing the potential being still being explored. And structurally, these have all been directly held products. However, we're now seeing managers utilize feeder structures in ETFs and quoted funds. Moving on now from ETFs and quoted funds, this slide goes hand in hand with the increase in unregistered wholesale product types, which we have seen in the last 100. Essentially, feeder fund structures are increasing in popularity. In prior years, we have seen more direct structures, and you can typically associate those structures with equity fixed income product types based on how the markets have performed historically. However, we're now seeing that proportion shift to the indirect feeder structure. In most instances, overseas fund managers who are looking to establish products in Australia look to favour unregistered wholesale feeders And one of the main drivers is to utilize their proven offshore strategies rather than establishing a standalone direct vehicle. This approach allows managers to leverage existing track records and can also represent lower costs to entry. There are other considerations with feeder structures that need to be taken into account, including tax implications, controlled foreign corporation rules, matching liquidity mechanics with the underlying master fund, hedging strategies, all of which we're able to work through with managers and provide insights to assist with product design. Touching on CFC rules, there are threshold tests relating to controlling interest that needs to be considered regarding a feeder fund's investment into an underlying master fund. It's important to understand what this looks like in order to determine whether an indirect feeder structure is the most appropriate. Moving on to master fund locations of feeder products, if we take a look at the last 100, you can see the breakdown on the most common locations and offshore vehicle types on the right. Diving into this, Luxembourg SICAVs and SCSPs remain popular at 25%. Dublin ICAVs compared to prior years are increasing, with the number of other vehicle types like US vehicles, Caymans remaining constant. We are seeing the emergence of business development companies or BDCs as a master fund vehicle and have been receiving a lot of interest from fund managers looking to understand BDCs, in particular, the tax implications associated with this structure. Australian Managed Investment Schemes as a master fund vehicle represents 21% of the whole pool. However, we're now seeing that progressively shift to newer offshore vehicle types. The key takeaway from all of this is we can support fund managers with offshore investment vehicles of all types and are essentially master fund agnostic. Similar to master fund locations, we support managers in all major investment hubs globally, and our clients are represented in almost every continent around the world. Looking at the last 100, Australian fund managers has increased to 71%, and this can be attributable to current market conditions in Australia, with domestic managers expanding on their product suite and setting up additional products. Global fund managers are now more active, as we touched on earlier, most of the demand coming from US and European fund managers, in particular, big global fund managers coming back to Australia, which is very pleasing to see. Now, in terms of distribution, this is one of the key factors that leads to a successful product, especially with offshore managers utilizing a feeder structure into offshore strategies. We have seen some fund managers adopt a fly-in, fly-out model, especially with borders and travel returning back to pre-COVID conditions, as well as single representatives typically utilized for products targeting institutional investors. Another common approach is managers opting to use third-party distributors, relying on their expertise and track record to assist with product distribution. There are also multi-affiliated groups offering distribution alongside responsible entity and trustee services. However, this can be costly, as these groups would typically take equity stakes in the business, and because of the bundled service, may pose issues to unwind at a later point in time. The ideal model in the long term is to set up local presence in Australia, utilizing a team of distributors to sell the products and supported by local product managers and operational teams. Ultimately, institutional investors and asset allocators will want to meet with portfolio managers and key investment decision makers of the portfolio, so having that local presence will be key. Although we specialize in providing independent responsible entity and trustee services, we can also arrange to introduce our panel of preferred third-party distributors to assist managers with distribution needs. On that note, I'll hand it over to Ben to discuss some of the other themes and trends that we have seen in FY24 and over the last 100.
Thank you, Alex, and good morning, everyone. Just kicking off from where Alex left, definitely some exciting themes and trends that we've seen, and this slide will look at the wide range of asset classes that we've established over the last 100. And what you can see is a full spectrum of asset classes. You can see there that domestic and fixed income vehicles make up almost 2/3 of the last 100 vehicles established. And comparing to the numbers from last year, the biggest increase has been in vehicles for alternatives. Looking further into the sub-asset classes on the right-hand side of the screen, it gives you a flavour of what some of our clients are investing into, and we can see products with exposure to private credit, private equity, and the infrastructure, to name a few. The story that is really evident here is the increase in demand for private market strategies, and in particular, open-ended evergreen strategies with a focus on private credit and private equity secondaries. The increase in infrastructure vehicles has in part been driven by bespoke vehicles established on behalf of institutions. These are often within co-investment structures where a high degree of independence in the trustee role is desired. EQT's capability in providing incidental and bespoke custody solutions for real and alternative asset classes means that these managers have been able to benefit from a cost-effective custody service offering a segregated and independent EQT. I've included this slide here to look more closely at the last 6 months and the vehicles established within that time. What we can see is that debt and alternatives stand out with greater prominence, especially when compared to historical levels, where alternatives have traditionally made up approximately 5 to 10% of our fund. Increasingly, it seems investors are looking for asset class diversification in private market assets, and this trend is likely to continue given market and rate volatility. Domestic and global fixed income remains popular for investors given high yields and the current macroeconomic backdrop. This slide here demonstrates the various investment strategies of the last 100 vehicles established, and it really highlights the prevalence of debt and alternative vehicles in comparison to previous years. We can see here that income yielding and capital protection strategies have been the most popular, which is not surprising given the direction of interest rates and inflation that is steadily persistent. Also, growth-orientated strategies have been quite popular, which again contributes to the alternative story that has been the main theme of the last 100 funds. Turning now to hedge funds and emerging themes that we are seeing. When we talk about hedge funds, we are seeing if it qualifies under RG240, that is passing 2 of the 5 tests, being whether the product uses shorting, derivatives, performance fees, leverage, and complexity of the product. In FY22, 1/4 of our funds qualified as hedge funds and therefore requiring a long-form PDS. This reduced to 16% last year and is down to 12% for the last 100 funds established. Looking through the data, the funds that do qualify this year have achieved hedge fund status through the use of derivatives in various forms to access asset classes that would not otherwise be available to them or their investors. Fund thematics have grown over the last 2 years, and today approximately 1 in 5 products that are launching have some kind of responsible investment lens through it. As you can see, 13% of new funds launched had an ESG theme, and we have seen new fund launches in ultra-ethical code of governance, Sharia compliant funds, sustainable development goal-orientated funds, and impact investing remains consistent with last year. Investment managers are becoming more sophisticated in their approach to responsible investment, and this is reflected in the wide range of responsible investment strategies being developed. It seems the industry has progressed from simply incorporating ESG into investment decisions or negative screening by excluding companies based on a set of ethical beliefs or values. There has been a clear shift towards strategies being developed that apply more active forms of ownership and that contribute to sustainable solutions and drive forward positive impact. And we've definitely seen that in the diverse range of products coming through in the last 100. This slide here provides a brief overview of the responsible investment market, and what we can see is a steady growth in responsible investment AUM over the last 5 years. Globally, responsible investment AUM reached 3.4 trillion at the end of 2023 and now represents around 7% of total global assets under management. Responsible investment AUM peaked in 2021 and dropped off in 2022, and responsible investment funds tended to underperform traditional funds over this period due to challenging market conditions and their sector exposures, where they tended to be underweight energy and overweight technology, which did not work in their favour. However, we have since seen this dynamic turn around, and we continue to see growth in the responsible investment market and definitely within the products coming through at EQT. And I'll hand back to Alex for some interesting and unique funds that we've established in the last 100.
Thank you, Ben. Some great insights. Now, this is one of our favourite sections in the 100 where we get to showcase some of the unique and interesting products across various asset classes. And these are products that we have either launched or are currently working on. With infrastructure, we were approached by an infrastructure provider looking to facilitate renewable energy initiatives. This involves the construction of renewable energy infrastructure through a section of land running through rural Victoria. While not considered a standard registered managed investment scheme, the product is to be structured as such given the nature of investors. The underlying investors, being the landowners, receive units in the fund and royalties in exchange for supporting the development and ultimately the development of the rural community. We also launched a private equity product with a global fund manager offering a differentiated and compelling strategy, all to do with reducing plastic and greenhouse gas emissions in the plastic value chain and transitioning these to sustainable outcomes and potential financial returns at the same time. For domestic and international equities, we're currently working on a product focusing on positive social impact, in particular economic equality for women and children. The product is essentially designed and run by women in the funds management industry. What also makes this unique is that there are no fees associated with the product. Service providers are waiving their fees and no management and performance fees are charged. Additionally, a percentage of NAV is also provided to not-for-profits on a monthly basis. And finally, for private credit, we launched a product with an overseas private credit manager, and it was unique due to the concept of a separate runoff class for the purposes of redemptions. Due to the illiquidity of the underlying loans within the master fund and when an investor redeems, the units are reclassified into a separate runoff class until the underlying loans mature and the redemption proceeds paid out, with timings of up to 4 to 5 years. During that time, the investors in the separate runoff class will continue to receive separate unit prices and distributions compared to investors who remain invested in the product. This structure and runoff class concept provides a liquidity mechanism to both managers and their investors.
Thank you, Alex. Turning now to the year-on-year flows. Just to note, this is not the last 100 funds we've established. This is all of our book. And as Mick mentioned earlier, we supervise approximately 500 products with either trustee or responsible entity. So these are the year-on-year fund flows across fund type, across all the vehicles we look after. We can see that the theme is largely consistent with the analysis from earlier. That is that the money is moving into unregistered funds, although we have seen strong flows into registered vehicles and ETFs or quoted funds, as you can see. A number of these registered funds aren't directly attracting retail money, but are also there for institutional and wholesale investors via platforms. We've seen more commonly, traditionally wholesale managers are launching registered investment schemes to access all investor types. There have been strong flows into our suite of exchange-traded vehicles, and as Alex mentioned earlier, we currently issue 15 ETFs, and it's become a very popular structure for both managers and investors alike. The Australian ETF industry has reached over 200 billion in FUM, and over 35 billion of this is in active ETFs. Just to note, active ETFs, in our opinion, are very much in their infancy in Australia, but the activity and flows you're seeing across our products would suggest that there is a long way to go. By comparison, in the US today, active ETFs make up approximately $500 billion, an amount that has tripled since 2020. And in our view, Australia is on a similar path. This slide here looks at the flows year on year by asset class, and we can see a very clear trend in capital flows towards international equities, domestic and global fixed income, alternatives, and real assets. So really across the full spectrum in the last 100. The increase in flows in global equities has been driven partly by strong performance of the asset class, especially when you compare to last year when some of our global equity managers suffered some large institutional mandate losses, mostly from superannuation funds. Similarly, global and domestic fixed income have had strong flows over the period, which is not surprising given the current environment, which offers a unique opportunity for bond investors to capitalise on high yields and lower volatility, making fixed income a compelling choice for de-risking portfolios. I mentioned earlier the very clear trend in demand for alternative asset classes in the funds we're establishing, and they have had strong flows over the period, and we expect that trend to continue. This is similar to real assets, which have shown strong flows over the period with valuation pressures from risk-free rates subsiding. Having a look at some of the licensing options that our managers utilise, more and more of our clients are relying on a CAR agreement or a class order relief from their own jurisdiction. We expect that this trend will continue given that there is often a lag between the time taken to establish a vehicle and the time taken for ASIC to grant an AFSL. Just on the topic of the class order relief, there have been some changes, and the prior sufficient equivalence relief and limited connection relief that foreign financial service providers enjoyed was repealed on the 31st of March 2020. The relief instruments were initially replaced with the foreign AFSL regime and a new and narrower funds management financial services relief. After Treasury consultations, transitional arrangements for those relying on the sufficient equivalence relief and limited connection relief have been extended until the 31st of March in 2025. On the 30th of November in 2023, a bill was introduced into Parliament. Chapter 5 of the bill relates to the foreign financial service provider exemptions, and the bill was referred to the Senate Economics Legislation Committee, who expressed their support in favour of the bill. If passed, the legislation is due to commence on the 1st of April 2025. The bill amends the Corporations Act to ensure regulatory oversight of foreign financial service providers in Australian markets while facilitating provision of cross-border financial services, and proposes 2 new exemptions from the 1st of April. The professional investor exemption, and then second, the comparable regulator exemption. Now, on the topic of regulation, I'll hand over to Michael Tropea, who'll give you a quick rundown of reg changes that are shaping our industry.
Thanks, Ben. Just checking the line. Good morning, everyone, and thanks for the warm welcome at the beginning, Mick. It's great to be here this morning. The purpose of this slide is, I guess, really to give a flavour of the sort of regulatory environment that we're operating in the current times. A clear trend that emerges and is fairly obvious is a trend of increasing regulation across the financial services industry, both in terms of the scope of what regulation covers and just the degree to which our activities are regulated. Another trend I'd probably point out that might not be so obvious, but we're seeing increasingly in our interactions with APRA and ASIC, is the expectation that we will also we will also monitor and oversee activities of third parties that we interact with, even where those third parties are licensed. And I think historically it's been industry practice that where you're engaged with another licensed entity, you can rely on them to perform their activities in accordance with their license, and you don't need to worry too much about that conduct. Clearly, that's no longer the case certainly with recent ASIC guidance, and where there's an increasing expectation on all of us to double check, or I guess to make sure and provide ourselves with due diligence and assurance that those third parties are performing in accordance with their requirements. Just to pick out a few of sort of the favourites from that list, we can see some quite fundamental changes occurred in the past 3 or 4 years, beginning really with, I think, design and distribution obligations regulation. That was really a fundamental shift in how products are issued and distributed. Again, particularly imposing obligations on issuers, where formerly it would only have ever been on advisors giving personal advice to concern themselves as to whether a product is suitable for their target market or their client. And of course, that introduced the target market determination, which is now a very big part of all of our governance requirements. The internal dispute resolution changes made at the same time really made timelines much, much shorter, and increased requirements on us to keep customers informed, and gave them rights to deal with advocates and representatives, and also a clear obligation on us to resource internal dispute resolution. Supporting that, of course, was the new breach reporting regime, where we had, again, stricter timelines and more detailed notification requirements when it came to any breaches of our obligations. More generally, modern slavery applied not just obviously to our industry, but across the board. It does impose quite significant due diligence obligations, even on an industry like ours, where probably we're not hugely high risk. But hopefully we've all got our processes in place that have that running relatively smoothly. In July, clearly a new regime was implemented for corporate collective investment vehicles. A whole new vehicle created, and sort of new roles for the corporate director and a legislative regime to support that. And then in September 2022, we had the, again, significant uplift in fee and cost disclosure requirements came into effect for super and investment schemes. Again, that required more detailed breakdowns of fees and covered more types of fees than before. Again, demonstrating ASIC's focus on disclosure, The greenwashing requirements also introduced, given after ASIC expressed some concerns around statements being made without appropriate basis. Again, the expansion of so a review into the DDO obligations and how they were working in May 2023 also led to some additional changes and some tightening of those requirements, particularly around target market determinations. And then some big bang changes around remuneration also coming our way, and also the dealing with entities who are facing financial trouble, with those changes coming in 2024 and 2025. I think the future, what the future holds for us, or in particular what we presumably are currently working quite hard on, the changes to the operational risk management framework, and which basically consolidates a number of standards into a single standard, but imposing stricter requirements and far more detailed, as I said, far more detailed oversight and monitoring requirements on third parties that we engage with. And this will be quite a fundamental shift, I think, in how financial services companies interact with one another, and we'll need to see significant changes from end to end in our contractual relationships, so beginning in how contracts are drafted, the due diligence we conduct before onboarding a new service provider, all the way through to regular reporting and monitoring and termination options in the event of failure. I think that there would need to be significant uplift in all of our operational risk management and business continuity frameworks and policies to reflect that new regime. Just moving on to the next slide very briefly, because I'm conscious we want to leave some time for questions. Again, one change we wanted to call out is an upcoming proposal for Treasury to review the regulatory framework for managed investment schemes. At this stage, we've received a consultation paper that essentially asks a number of questions around areas of potential improvement in that regulatory framework, given it's been in place largely unchanged since 1998, which is a lifetime in regulatory landscape. Areas the Treasury seem to be focusing on are the definition of wholesale client and the thresholds to satisfy that test, consent requirements for wholesale clients, the process for replacing a responsible entity, minimum liquidity requirements, the rights of investors to withdraw their investments, and also whether the investments made available to retail clients should be limited in various ways. While no doubt some of these regulatory changes would provide additional protection and would have merit, of course, any regulatory change imposes additional costs, both upfront in terms of systems changes that need to be made, and to the extent there's additional ongoing compliance. For example, if there's a requirement to continue to monitor whether an individual meets the definition of wholesale client, that will have additional costs that need to be borne by ultimately the consumer. We did make a submission on this with certain comments around their proposals. Our broad thrust, without going into too much detail, our broad thrust is that we feel the existing framework is working quite well, and while some tweaks would enhance it, fundamentally we don't see the need for major change in this area. But of course, the improvements can always be made. That's probably the end of my words. I'll hand back to Ben for the final slide.
Thank you, Michael. Overall trends and takeaways for today before we wrap up and go into a couple of questions. But in summary, it's been a very strong period for our trustee RE services business, with strong growth in FUM and great diversity in product types, asset classes and structures. ETFs and quoted funds continue to attract attention from investment managers and investors alike. And in my opinion, and comparing to our international counterparts, it's likely that this trend will continue. Global fund managers coming back to Australia. We can see that Australia continues to be an attractive destination for offshore managers in recent times, and this is driven by managers looking to leverage existing strategies offshore and looking to tap into the growing superannuation market, expansive retail opportunities, and an environment which is underpinned by robust governance structures and one of the safest banking systems globally. Alternative asset classes are much higher than we've seen historically, as we discussed earlier, as are wholesale and unregistered vehicles, although we have seen strong flows into registered schemes as managers are looking to access the whole investor pool via platforms. Fixed income, after a tough period, fixed income instruments have become an attractive asset class again, offering attractive yields and diversification benefits. And finally, the responsible investment market continues to evolve, and we are seeing more investors choosing to invest with a focus on environmental and social outcomes alongside a financial return, and we're definitely seeing that coming through in our product suite here at EQT. I think we'll now dive into some questions, a Q&A. There's been a few that have popped up, but I'll let Michael read those out and pass them around to the group.
Thanks, Ben. So I think the first question we have, what do you see as the main considerations for managers in establishing a new vehicle? I mean, I'll add a couple of points, but I'll then open to Ben and Alex to see who wants to provide some additional info. I mean, if that question is directed at, establishing it, whether they decide to establish it in Australia or Singapore, for example, I would think a manager would be keen to consider the sort of regulatory framework and tax framework and access to capital markets that the jurisdiction provides. And obviously that's where, when I talk of costs of complying with regulation, that is one of my concerns, and that each time our regulatory costs increase, we become a little less desirable as a market for investors. But obviously overall our stable regulatory environment is seen as a real positive. I'll open to Ben and Alex if they want to add any from a broader perspective.
Thank you, Michael. I guess from my perspective and what I'm seeing, it really depends, or it changes a little bit depending on whether you're a domestic or a global manager. But across both of those manager types, choosing the right partners to support you here is key, really. That includes the trustee, responsible entity, admin, registry, audit and tax advisors. From there, and I think Alex touched on this earlier in the session, distribution capability is essential, and there are a range of models that can be utilised to support that function. This also includes identifying your target market or investor base. Are you trying to attract insto, wholesale or retail, or indirect retail via platforms and wealth advisory groups via an APL to include in their portfolio solutions, managed portfolio solutions. For offshore managers specifically, I'd say it's important to align product specs with those common and desired in the Australian market. This includes hedging, liquidity and redemption frequencies and terms. And then for feeder fund structures, which have become common, as Alex mentioned, I'd say it's also important to consider any tax implications, which are in part driven by the Australian tax classification of the offshore master fund, and also the Australian tax treatment of any income received or realised gains on the feeder's investment in the underlying investment vehicle. Overall, I'd say choosing the right partner with the depth and breadth of experience to provide insights into all of those considerations is probably the key factor, in my opinion.
Okay, thanks, Ben. Next question, got dual access ETFs more popular models, and if so, why is that?
Yeah, I'll take that one. It's a good question. Yeah, so I guess from our perspective, most of the inquiries that we receive are relating to quoted funds or conversions of quoted funds. So from our perspective, we do believe that quoted funds are probably the most popular choice. We do have the ETFs in our stable, but predominantly these are largely quoted funds or conversions to quoted funds. The biggest advantage from my view is that, it's the ease of use and accessibility to investors. So rather than filling out a paper-based application form, having to submit that to the registries for AML KYC, people can just purchase units into the product on trading platforms on the fly, whether that's through CommSec or those types of platforms. So yeah, I think that's probably the most popular structure.
Thank you. Next one I have, what trends are you seeing in terms of fund closures?
Yeah, I might kick this one off. Michael and Alex might be able to add some insight here. We have definitely seen some more fund closures over the period. There've been pressures on, I mentioned earlier, some mandate losses, institutional investors taking investment capability in-house, which has affected some of our managers. So I'd say they have been slightly higher this year compared to previous years. And again, that's driven by the institutional superannuation space, in-housing investment and fee pressures across the industry as well. So some of those mandates have just become unviable for some managers to take on. Alex, was there anything you wanted to add, or?
No, I think you summed it up pretty nicely on that one, Ben.
Thank you.
Great. I mean, the next, I think, which is, you've mentioned private equity funds are seeking open-ended structures. How do you assess whether these funds can provide appropriate liquidity?
That's a great question. So I mentioned earlier the prevalence of private equity secondaries, and they're typically more liquid, and these are typically feeder funds into offshore vehicles. So we make sure to align redemption mechanics with the master and the feeder. And the secondaries market in general is a little bit more liquid, so there's a robust secondary market for these types of assets. In saying that, there are obviously periods of illiquidity, and we make sure they're disclosed adequately to investors. Interestingly, on that point, a lot of these vehicles are now becoming registered vehicles, as we touched on earlier, to access platforms and APLs and advisor managed portfolio solutions.
Nice. Thanks again, Ben. There is one for me. Why is there an increased focus from Treasury on wholesale clients specifically? I mean, well, obviously, I don't know the internal workings of Treasury. The wholesale exemption is always, in a sense, in their sights. It applies obviously more broadly than just in this context, because it provides significant exemptions to the regulatory requirements for issuers and for distributors. Treasury will always, I suppose, want to be sure that the definition remains appropriate. And I guess given it often has monetary thresholds, as either inflation or wage increases or growth in the economy, means those dollar numbers become less difficult to meet. It will become concerned if it sees too many people hitting the exemption, because essentially it undermines the regulatory framework that they've put in place, or they would perceive it as undermining the regulatory framework. Keeping in mind, the reason wholesale clients are exempted from a lot of the regulatory requirements is because they're expected to know enough or have enough information, knowledge and expertise to be able to make decisions on risk for themselves without the need of assistance. So that is my expectation as to why Treasury will be focusing on that definition specifically. And it's a pretty common thing for them to review whenever they're doing a review of a regulatory framework like this one. I think we've probably got time for one more quick question. I'm just going to see, how about given we talked about ESG funds, do you think that the asset greenwashing, rules and headlines and court cases will lead to a decrease in the setup of ESG funds in Australia?
Thank you, Michael. I'll take that one. Just conscious of time, we've almost hit the 45 minutes, so I'll keep it brief. No, to the contrary, we've actually seen more ESG products coming through. And as I mentioned earlier, the approach has become a little bit more sophisticated. So really taking active forms of ownership and selecting investments that drive forward positive impact. And that can take various forms. So what we're seeing, rather than managers move away from ESG funds, they're actually becoming more sophisticated in their approach and choosing other ways to invest with an ESG or responsible investment theme. So there's just more products coming through and a more diverse range of products coming through.
Great, thanks, Ben. So with that, I think that brings that Q&A to a close and this seminar. Thank you everyone very much for joining. It's been a real pleasure speaking to you this morning. I hope you found the content of this talk useful. We will be reviewing any unanswered questions and try and answer those by email if your address is provided in the list. And otherwise, enjoy the rest of your day. See you all soon.
Thanks, everyone.
Thank you all.